Hi, I'm Otto from ORATS. Two traders look at the same option. One says it's cheap, the other says it's expensive. They're both looking at the same price. So who's right? Before you can say an option has value, you have to decide what you're comparing it to. Price is just a number. Value is a comparison. If you don't define the benchmark, cheap and expensive don't mean anything. At ORATS, we approach true value using 3 different reference frames. Each one answers a different question. The first is what we call S%. This compares the current option price to a cleaned version of today's volatility surface. Raw implied volatility can be noisy. Wide bid-ask spreads, put-call imbalances, and microstructure effects all distort what you see on screen. So the first question is structural. Is this option rich or cheap relative to a smoothed, internally consistent version of the current market? S% measures that. It's not asking whether the option is high or low compared to history. It's asking whether today's quote makes sense relative to today's market structure. That's market relative value. The second reference frame is D%. This shifts the comparison from structure to history. Instead of asking whether the option is aligned with the current surface, you ask whether it is aligned with what the stock has actually done in the past. If implied volatility is pricing in a certain level of risk, but the stock's historical distribution of outcomes tells a different story, that gap matters. D% compares the market's implied distribution to the range of moves the stock has actually delivered in the past. Not just the average move, but the full shape of historical outcomes. This is statistical value. It grounds today's expectations in actual past behavior. The third reference frame is F%. Markets are not static. Volatility regimes shift. Earnings cycles change. Macro conditions evolve. So the third question is forward-looking. Is the option aligned with where volatility is expected to move? F% compares current pricing to ORATS's volatility forecast. If volatility is expected to expand and the market is pricing contraction, that misalignment matters. If volatility is expected to decline and the market is pricing expansion, that matters too. This is expectation relative value. Now here's the important part. These 3 measures are not competing definitions of value. They are different lenses. S% asks, is this option mispriced relative to today's cleaned market? D% asks, is this option misaligned with historical outcomes? F% asks, is this option inconsistent with forward volatility expectations? Sometimes all 3 point in the same direction. Sometimes they conflict, and that disagreement is information. An option might look fair relative to today's surface, but rich relative to history. Or it might look statistically cheap, but structurally aligned. True value is not a single number. It depends on the comparison you care about. If you're trading short-term dislocations, structural value may matter most. If you're trading long-run probability edges, historical value may dominate. If you're positioning around regime shifts, forward value may be decisive. The key is clarity. Instead of asking, is this option cheap? You ask, cheap compared to what? That's how you move from reacting to prices to measuring value. In the ORATS platform, S%, D%, and F% are displayed side by side so you can see those comparisons directly. You're not guessing whether an option is rich or cheap, you're defining the benchmark first. And that's the difference between price and true value. If you want to explore how these measures work across different stocks and strategies, you can learn more at orats.com. I'm Otto. See you next time.